The worst employment figure in the United States since 2003 is not just another bad headline buried inside a monthly jobs report. It is a warning signal that the economic cycle may be turning. And if you think this is just a temporary slowdown, you may want to stay until the end because the implications go far beyond payroll numbers. The labor market is one of the core pillars of the US economy. When it begins to weaken, it usually means the cooling process has already been underway for months. Business investment slows first, then hiring decelerates, projects get postponed, and finally, layoffs begin. Comparing today to 2003 is not dramatic exaggeration. That period followed the burst of the dot-com bubble when the economy was digesting financial excess and inflated expectations. After years of massive liquidity, historic fiscal stimulus, and ultra-cheap credit, the US economy is now confronting the consequences of one of the most aggressive monetary tightening cycles in decades. Higher interest rates have fundamentally changed the financial landscape. Borrowing costs are up, credit is tighter, small and mid sized businesses are under pressure, and consumers are more cautious. The Federal Reserve now finds itself in a delicate and uncomfortable position. Its dual mandate requires price stability and maximum employment, but today those goals are pulling in opposite directions. If the Fed cuts rates too quickly to protect the labor market, inflation risks reigniting. If it keeps rates elevated for longer to ensure inflation is fully contained, it risks accelerating job losses and pushing the economy into a technical recession. That policy tension is fueling market uncertainty and volatility across equities, bonds, and currency markets. The impact would not stop at America's borders. The United States remains the largest economy in the world and the primary engine of global consumption. A sustained weakening in U.S. employment would likely reduce import demand, pressure commodity prices, and tighten financial conditions for emerging markets that rely on American consumers. The dollar's trajectory, global capital flows, and international market stability are all tied, directly or indirectly, to the strength of the U.S. labor market. When American hiring slows meaningfully, ripple effects spread through global supply chains, trade balances, and investor sentiment. But there is a deeper structural layer to this story. The labor market is not only cooling, it is evolving. Automation, artificial intelligence, and corporate efficiency drives are reshaping workforce needs across sectors. Many firms that overhired during the post pandemic expansion are now recalibrating staffing levels. Even if the economy stabilizes, not all traditional jobs will return. Productivity gains through technology can support output without requiring the same level of employment growth. That structural shift makes the current slowdown more complex than a typical cyclical dip. In the near term, the most likely scenario appears to be a slowdown with elevated risk rather than an immediate collapse. Economic cycles do not disappear, they transition. The post pandemic expansion, fueled by stimulus and liquidity, appears to be losing momentum, and the economy is entering a more fragile, selective phase. Whether this becomes a mild adjustment or something more severe will depend on how the labor data evolves, how the Federal Reserve responds, and how resilient consumer spending remains. Understanding this moment is not about panic, it is about recognizing inflection points. Major economic turning points rarely announce themselves with dramatic crashes. They begin with subtle data shifts that many underestimate. The worst employment reading since 2003 may prove to be just a temporary stumble, or it could mark the beginning of a broader reset. The difference will be determined in the coming months. If the labor market is truly entering a fragile phase, the first priority for policymakers is calibration, not panic. The Federal Reserve must shift from a purely inflation fighting posture to a data dependent balancing strategy. That does not necessarily mean immediate rate cuts, but it does require flexibility. If labor weakness accelerates while inflation continues trending downward, gradual and clearly communicated rate reductions could prevent a sharper contraction. Monetary policy works with lags, and over tightening has historically been one of the main triggers of deep recessions. The Fed's challenge is to avoid breaking demand while still anchoring inflation expectations. Clear forward guidance and transparency will be critical to reduce market volatility and prevent financial tightening from amplifying labor stress. Fiscal policy also has a role to play, but it must be targeted and disciplined. Broad stimulus checks or aggressive deficit expansion would risk reigniting inflation and destabilizing bond markets. Instead, policymakers could focus on productivity enhancing investments, infrastructure modernization, supply chain resilience, semiconductor manufacturing, and clean energy deployment. These types of investments support employment without simply injecting temporary consumption. In addition, workforce retraining programs aimed at displaced workers, particularly in manufacturing, logistics, and administrative sectors, can soften structural dislocations caused by automation and artificial intelligence. The key is shifting from short term relief to long term competitiveness. From a corporate perspective, businesses should prioritize balance sheet strength and operational flexibility. In a slowing labor market, firms that maintain liquidity and reduce leverage are better positioned to navigate demand volatility. Companies can also reassess capital allocation, favoring strategic investment in automation and digital efficiency rather than aggressive expansion. This does not mean freezing growth, it means growing selectively. Firms that adapt early to structural labor changes, integrating AI tools, optimizing workflows, and upgrading workforce skills, will likely outperform those that simply cut headcount without rethinking productivity models. For households, preparation and financial resilience become central themes. A weakening labor market increases job insecurity, even for workers in previously stable sectors. Building emergency savings, reducing high interest debt, and prioritizing liquidity can provide insulation against employment volatility. At the same time, investing in skill development, particularly in technology, analytics, and high demand technical fields, can increase employability in a structurally evolving economy. The labor market of the next 5 years will reward adaptability more than tenure. Workers who continuously upgrade skills will have stronger negotiating power even in slower growth environments. On a broader economic level, strengthening domestic supply chains can reduce vulnerability to global shocks that often compound labor downturns. If companies localize or regionalize production strategically, they can create more stable employment ecosystems. The reshoring and nearshoring trends that began during the pandemic could be reinforced through incentives that encourage advanced manufacturing within U.S. borders. This does not eliminate global trade, but it diversifies exposure. A more resilient supply chain architecture reduces the probability that external disruptions accelerate domestic job losses. Ultimately, what can be done depends on recognizing whether this is a cyclical slowdown or the beginning of a structural reset. If it is cyclical, measured monetary easing and steady consumption can stabilize the system. If it is structural, the solution requires deeper transformation, investment in innovation, workforce evolution, and productivity enhancement. Economic turning points reward those who adapt early. Policymakers must avoid overreaction. Businesses must prioritize resilience, and workers must invest in adaptability. The labor data may be flashing caution, but how the United States responds will determine whether this becomes a soft landing or a harder economic reset.